Globally, a number of countries are at a risk of a debt crisis. Take for an example our neighboring countries. Sri Lanka faced a default on its international debt in the previous year. Similarly, Pakistan is also grappling with political and economic challenges that have put the country in a tough financial position. Now, other nations such as Egypt, El Salvador, Ghana, Lebanon, Malawi, and Zambia are currently experiencing a debt crunch or have already defaulted on their international loans. Now, amid the global debt crisis, where does India stand? How much do we owe and who owes it? More importantly, how does our debt position compare to other economies, especially our other emerging peers? Let's talk about this. In a recent DITM video, we discussed the latest developments in the oil markets. Oil prices have come down after hitting all-time highs, but have experienced significant fluctuations. What's causing this fluctuation and what role do these big oil-producing countries have to play? We will also dive deeper into this intriguing topic. Let's begin. You're watching Informed Investor, the Third Empire, an initiative by Research and Ranking. First, let's get the basics of debt right. When it comes to debt, there are two types: domestic debt and external debt. Domestic debt is the money a country borrows from its own people, banks, or institutions within its borders. Now, external debt, on the other hand, is money borrowed from outside the country. Now, this can be from other governments such as Japan lending to India, or international organizations such as the IMF or Asian Development Bank. Now, countries often rely on external debt to finance big things like infrastructure development or to cover expenses when they don't have enough money. Now, generally speaking, domestic debt is considered less risky than external debt. Domestic debt is typically denominated in the country's own currency. This means that fluctuations in exchange rate have less impact on the repayment of domestic debt compared to external debt. Now, governments also have more control over domestic debt, and this domestic debt is also less exposed to geopolitical risk. Because external debt is more riskier than domestic debt, let's focus on India's external debt and see to what extent do external entities have control in India. In the 3 months to December 2022, the external debt in India was at $613.1 billion. Now, this of course seems like a massive amount. However, India's external debt is absolutely normal. One measure to check India's debt position is to analyze the external debt to GDP ratio. External debt to GDP is a measure that tells us how much a country owes to foreign lenders compared to the size of its economy. Think of it like checking how much money you owe compared to how much you earn. Now, India's external debt to GDP ratio declined to 19.1% in December end of 2022, and this number is actually one of the lowest in the world. Take for example Singapore. Singapore is a very small country, but has the highest external debt to GDP ratios among the major economies. Its external debt to GDP ratio stands at a staggering 385%. Now, this is not necessarily a bad thing. Singapore is a major financial center and a business hub. As a result, both foreign investors and local financial institutions engage in borrowing and lending activities, contributing to the accumulation of the external debt. Now, it is important to note that the external debt to GDP ratio does not necessarily indicate a negative situation. Countries can effectively manage their debt and sustain economic growth even with a high ratio. Now, coming to India, India has a low external debt to GDP not because of its reluctance to borrow, but because it depends on its domestic means, also because India's economy is growing extraordinarily fast. India's external debt burden grew consistently in the last 2 decades. If you see the absolute value of external debt, it has grown from $101.1 billion in 2001 and now it is at $613 billion. However, India's GDP has also increased manifold in this period. As a result, India's external debt to GDP has been manageable. Now, let's understand what entities of the countries own this foreign debt. Now, India's external debt is composed of 2 sectors, the private sector and the public sector. Private sector external debt refers to the external debt owed by private entities in India, such as private companies, banks, and other non-governmental organizations. Now, public sector external debt refers to external debt owed by the Indian government and government-owned entities such as state-owned enterprises and public sector banks. Now, both private sector and public sector can contribute to India's overall external debt burden. Now, when we look at the breakup of the debt, government only owes $129 billion out of the total $613 billion of debt. We see that the government does not hold the majority of debt. So who does? Now, the rest of the debt comes from private sector, which is financial or non-financial corporations. Non-financial corporation holds $252 billion in debt, while the financial corporations own about $200 billion. Now let's also focus on India's overall debt to GDP, which includes both the foreign and domestic debt. A government's debt to GDP ratio, which compares the size of a country's debt with its economy, is one indicator of a government's financial sustainability. Now, any value greater than 100% indicates a country is spending more than it is making. In fiscal year 21, which was a pandemic year, India's debt to GDP ratio had gone up to 89.3%, and the ratio has now fallen to 81.3% by the end of March 2023. Now, though these numbers are historically high when we compare to other economies, India actually has one of the lowest debt to GDP ratios. Japan, the world's third largest economy, has the highest debt to GDP ratio at 239%. Now, borrowing also entails interest payments and debt servicing costs. Now, if debt levels becomes unsustainable, a significant portion of government revenue may be allocated to debt prepayment, limiting funds available for other essential expenditures. Now, the good news for India is that despite the spike in external debt, the cost of servicing actually went down. For instance, as of December 2022, the debt service ratio fell to 5.3% of current receipts from a high of 8.2% in 2021. To conclude, when we talk about debt, it is a need for any economy or a company to grow. Now, debt is an essential tool for expanding an economy as it provides necessary funding for investments and stimulates economic growth. Now, debt only becomes a cause for concern when political stability is compromised or mismanagement of these funds occurs. Fortunately, India's debt situation seems to be reasonably comfortable. Now, various indicators that we just discussed determine the sustainability of debt are in line with past trends, which suggests a favorable scenario. Now, this indicates that the impact of the current macroeconomic challenges is not expected to exert a significant pressure on the overall Indian economy. Oil is a superstar of energy sources, powering our cars, factories, and even the electricity that lights up our lives. Now, its close connection to economic growth makes it an essential commodity in the financial world. Now, the price of oil is influenced by various factors, from the classic forces of supply and demand to geopolitical events, macroeconomic conditions, and even market speculation. When we talk about demand for oil, it's all about how much people need it at a given time. Think of heat, electricity, and transportation. We rely on oil for all of that. And when an economy is booming, the demand for oil shoots up. Now let's talk about the big players on the supply side. OPEC takes the spotlight. OPEC stands for Organization of Petroleum Exporting Countries, a multinational group managing the production, supplies, and prices of petroleum. Now, they've been around since 1960s with 13 separate oil-producing countries as members. In 2016, OPEC joined forces with other top non-OPEC oil exporting countries, forming the powerful OPEC+. Now, the plus denotes countries that collaborate on decisions but aren't official members. Now, some important names in the alliance include Kazakhstan, Mexico, and Russia. Now, OPEC, with its immense reserves and around 40% of global supply, has a significant influence on oil prices. So, what else drives oil prices? Now, when tensions arise in oil-producing regions, it can lead to problems with crude oil supplies. Now, if there's a war or conflict in these areas, it can threaten the availability of oil, which in turn affects its price. Take the Russia-Ukraine crisis, for example. It had caused oil prices to skyrocket to over $120 per barrel, even though just 2 years ago, during the pandemic, oil prices hit record lows. So geopolitical events can have a huge impact on oil prices, making them go up and down like a roller coaster. Now, coming to the current scenario, after hitting an all-time high during the Russia-Ukraine crisis, oil prices have been trending lower. If you look at this chart, over the last 6 months, oil prices have been quite volatile, fluctuating between $68 per barrel to $84 per barrel. Now, you might be wondering what's driving the fluctuations in oil prices. Now, there are several reasons, but OPEC, the Organization of the Petroleum Exporting Countries, has been playing a crucial role. They've made multiple cuts to oil production, creating chaos in the market. In October last year, OPEC Plus slashed productions by 2 million barrels per day. Now, this move didn't sit well with US President Joe Biden as it threatened higher gasoline prices right before the midterm elections. Then, in a surprising move, several OPEC members cut 1.16 million barrels per day in April this year. Now, speaking of Saudi Arabia, the world's top oil exporter, they've also recently announced additional voluntary output cuts starting from July. They plan to reduce their daily oil production from around 10 million barrels to 9 million barrels per day. Now, with Saudi Arabia being a key player in OPEC, their decisions carry significant weight in the global oil market. Now, you might be curious about why Saudi Arabia or other OPEC countries is cutting oil production in this time. Let's take a look at the state of global oil demand. Initially, oil demand took a hit due to the pandemic's impact on the economy. However, as we entered early 2022, concerns about supply issues related to the Russia-Ukraine situation arose. Now, these concerns sent oil prices soaring to all-time highs. Unfortunately, the high energy prices had consequences, including massive inflation. To counteract this, central banks raised interest rates, which had a dampening effect on the economic growth, particularly in regions like the Euro area and the United States. Now, we spoke to you about the strong linkage between oil demand and economic growth. Now, with the demand for oil being subdued, prices have declined from their multi-year highs. To put things in numbers, global oil prices have stayed below $80 per barrel for more than a month, experiencing a slump after briefly reaching nearly $85 per barrel in April. In fact, they've fallen more than 30% from the same point last year. To address the situation and stabilize oil prices, OPEC has made moves to cut production. Now, this demonstrates their commitment to support prices despite the weakened demand outlook. Now, the reduction in oil production by Saudi Arabia may not directly impact India because Russia has become a significant crude oil supplier for India. Now, recent data reveals that Russia now provides around 42% of India's imported crude oil. But as OPEC's decision led by Saudi Arabia have a significant influence on global oil prices, they also raise concerns for India. As a country that relies on imports for over 80% of its crude oil needs, India is wary of the combined impact of Saudi Arabia and OPEC Plus announcing supply cuts. Now, these measures have the potential to drive up oil prices worldwide. To conclude, the recent production cuts by OPEC Plus and Saudi Arabia's voluntary reduction starting in July are responses to the weakened oil demand outlook. Now, with concerns about economic weakness in major regions and a slower recovery in China, these measures aim to support oil prices and bring stability to the oil market. Having said that, this is me, Merlin Susanna, signing off. Take care and stay invested.
Did you like watching this video? Then download our app, Informed Investor, to watch more such informative and interesting videos.